You should only buy growth companies while you're young, and then do dividend investing when you're older. In this video, I'll share with you why that advice isn't sound if you're trying to be an investor for the long run. With high growth companies, they use a lot of buzzwords and flashiness to boast about a speculative future with endless gains. It's the promise of rainbows and pots of gold that gets their stock price to balloon. So what I'm trying to say is that growth is easy to fake because it's generally accepted that growth companies are unprofitable and burning through cash. For a high growth speculative company, it's normal to see negative free cash flow, negative net income, and wonky numbers all around. Their balance sheet is not examined with the same strict guidelines that are placed upon dividend-paying companies. On the flip side, growth stocks really do have the potential to return about 1,000% in a single calendar year or burst up in flames. But the thing is, guessing which growth stock has that potential is like finding a needle in a haystack or your wiener after you take a cold shower. On the other hand, dividend investing requires you to be knowledgeable about what makes a company solid or high quality. You, as an individual, actually have to understand the numbers, finances, and even ratios like the dividend payout ratio. Unlike growth companies, you cannot fake a dividend. Companies either issue a cash dividend or they don't. They either grow the dividend payout annually or they don't. And to measure the quality of a dividend, the financial fundamentals really matter. Because as a dividend investor, you wouldn't want to invest in a company that looks like a growth company, right? With negative cash, negative profits, and a shaky balance sheet. And because the criteria for a good dividend company is more strict, I think that dividend companies are probably the best way to introduce young people or people who are new to the stock market in general to the world of investing. Because to fully comprehend the quality of a dividend, they have to first understand the fundamentals of the business itself and the balance sheet. And by doing so, they'll learn how to calculate an intrinsic value for a company's stock. And if you're going to do something, you might as well do it right the first time. If you teach someone new to the stock market gambling techniques with growth stocks, it's like taking a step in the wrong path. Kind of like making the decision to get into shape, but having your fridge stocked full of beer, junk food, and bull testicles. Every step towards progress you make will be 10 steps backwards because of your diet. So set yourself up for success and do it the right way right out of the gate. But I think before I do any more explaining on why dividend investing makes sense, it is probably good for us to get a refresher on how stocks work to make us money. So successful business operations can return value to shareholders in 3 different ways. Number 1, the business can do the right things and do better and better, which leads to more cash. Then they can utilize their earnings to expand and grow the business. And as they report higher and higher revenues each quarter, the stock price will increase. Not always, but usually this is the case. Number 2, the company can issue dividends, which are cash payments to the shareholders because the company has abundant cash on hand. More cash than they need to grow the company at a healthy and reasonable rate. Instead of overpromising and under-delivering, they choose to forecast more accurate growth numbers and give the rest to shareholders as dividends. Based on what I just described, you could probably assume that dividend companies tend to be more mature and stable. So you can think of the dividend as money to buy a burger or whatever else you want. Like if you want to be a big weirdo with big puffy nipples, you can treat yourself to a McDouble every time you get a dividend from McDonald's. All right, pop quiz time. What is a dividend? Boo-doo-doo-doo. That's right. It's when the excess cash goes from the company to the owners. It's not free money, but it's money that you earned as an investor. And number 3, the company can buy back shares on the stock market and reduce the number of shares outstanding available. When there's less shares outstanding, this increases the price of current shares by boosting their earnings per share. So those are the 3 ways stocks return value to the shareholders. With dividend paying paying companies, they usually do two of the three. Case in point, right now, Apple, Altria, and Google are issuing dividends that are growing every single year, and they're buying back shares. Dividend paying companies return more value to the shareholders because they are established companies with predictable profits and reliable growing cash flows. So when I hear someone describe themselves as a dividend investor, what I hear is someone that prefers companies that have less volatility and is consistent. And they probably prefer being able to sleep at night, not having to worry about their stock investments, which to me is a perfectly reasonable investment decision and choice. Not everyone has the stomach to YOLO all of their life savings into speculative biotech companies that may or may not bust. Oh, and by the way, most dividend investors are also value investors, which means they don't like overpaying for companies. But can you blame them? Probably the same type of people to reuse the same rusty razor they've been using since college to save money. And here's the thing with Altria. While you hold that stock, you'll get like 9% in dividends, and when you sell the stock, you'll get gains from that too. If the price goes up and if you decide to sell the stock, that is. If you're wondering what my opinion on Altria is, then watch the video I made analyzing the company because hands down, I truly believe it's the best deep dive available on YouTube. Otherwise, I'm going to tell you right now, you'll be pooping more than twice today like an animal. And we don't need that because your lady will complain about how stinky the bathroom is. I'm just saying, it could be one less argument in your life. So it would behoove of you to watch the video. And what's funny is dividend investing comes and goes out of fashion every decade or so, just like long hair on guys. And apparently, right now, it's cool to have long hair again, fellas. For instance, back in 1999, if you invested into anything other than website stocks, you were labeled as dumb. The internet was just becoming a thing. And by the way, I'm old enough to remember dial-up internet. And it was exciting times because it seemed like every other day, a new website would be born. And those websites would declare and become publicly traded. Then Wall Street went on a conquest to overbuy through greed all of those website stocks. Then we know what happened to those growth stocks in the following years. They crashed like crazy. Likewise, during the pandemic, when interest rates were low, there was a flood of new people to the stock market, and everyone and their cousin was going crazy over growth stocks. Again, that negative sentiment towards dividend investing was thrown around the internet because growth companies were taking out loans for little to no interest and promoted all sorts of hype into the ears of investors. And when the interest rates were low, some of those growth companies were actually making good use of the money, and they did some cool things. But then inflation started to punch us right in the balls. As a countermeasure, the interest rates ballooned up to what it is today at about 5.5%. And that meant growth companies had to take out unfavorable loans that were unsustainable. And we know as of recently how that panned out for those unprofitable growth companies after they got demolished. Like having a nail clipper snip off the tip of your nipples type of destroyed. So before you attack dividend investing, learn the facts and know that dividend paying companies have outperformed other styles of stocks in the S&P 500 in the long run. If we are going to be honest, it was emotions that fueled the growth stock frenzy that seems to happen every so often. With dividends, it's not emotions, but facts, data, and fundamentals driving the investment decision. And sometimes investors even think of dividends as a substitute for bonds and treasury notes. Whatever provides the higher yield is usually favored at that moment. But dividends are attractive to those who appreciate and possess a slow and steady mindset of a predictable stream of passive income. Like if you have ever set a running goal for yourself before, then you know it's impossible to shave off 5 minutes from your 5K time overnight. Improvement happens gradually, and with each calf cramp that you experience, you know progress is being made. So me, I am not a natural runner, and I actually despise running because it's a painful experience because I have flat feet. But I run anyways, So maybe I do dividend investing because I like pain and I like the idea of turning into a cardio bunny. Nah, jokes aside, big muscles are cool and all, but getting older and maturing is realizing that heart health is more important than having huge biceps, alongside with having less wrinkles on my scrotum from moisturizing properly in the shower. And here's another reason as to why dividends just make sense. With dividends and reinvesting those dividends, you can see and feel the tangible benefits after about 5 years or so. It's hard to put into words the satisfying feeling of seeing 70 initial shares of realty income grow into 120 shares. The compounding effect and machine is a beautiful concept. So yes, dividend investing teaches someone who is in their 20s or 30s or even 40s the principle of patience, persistence, and passive income. If you want to see a more detailed video that shows the effects of dividends compounding, then watch why the first $100,000 is important. Why should I dividend invest? And believe me when I say it's a better watch than anything else you plan on watching in the next 15 minutes, especially if it's dirty, you sick old man. Just because you do dividend investing, it does not mean that the selection of stocks will all be slow and mature. There's a style of dividend investing known as dividend growth investing that gives you the best of both worlds. It gives you the total returns of growth stocks, but also gives you a dividend that grows at a rate of 8% to 12%. So what that means is we can't buy the classic Warren Buffett stocks and expect the returns that he got. I'm talking about Coca-Cola, American Express, and the various oil stocks that he fancies. He bought into those companies back in the 80s and 90s. Their growth days are slowed down. To put it into perspective, Buffett bought a significant chunk of Coca-Cola for about $2.88 a share in 1988. Today, Coca-Cola trades for about $62 a share, not accounting for all the stock splits. So instead, as value investors who resonate with dividend growth investing, we have to find businesses that pay dividends right now, but have room for a lot of growth and opportunity in their future. I'm talking about the likes of Nvidia, Apple, Starbucks, Meta, or even Google, what you see on your screen right now. As of 2024, Google has returned 21%. So dividend growth investing is like marrying someone who is tall and athletic so that your future children will have the potential to make it to the NBA. And their basketball career can be your retirement plan instead of all of this investing nonsense. But with all that said, I want to make this clear. Do not chase the dividend yield. When I was new to the stock market, I was fascinated with the idea of dividend companies giving high yields like 10%, not understanding that their business fundamentals were terrible. And yes, even dividend paying companies can run into trouble if they try to pay a dividend that isn't sustainable from their forecasted cash flow. Luckily, that phase of my life was only for about 6 months. Then I learned to really dissect and analyze companies to make sure that they're high quality. That's why this isn't financial advice, but I would tell myself from the beginning to chase high quality dividend compounders with cheese, meaning companies that have a beautiful balance sheet, an economic moat, and business operations that are spectacular. If they are a good business, then their growth will be stable, predictable, and reliable. The dividend yield will eventually follow. A high quality company will have more cash than they need, and that will be transformed into bigger dividends or share buybacks eventually. And I get it. It's easy to fall in love with a crappy company if they have a high dividend yield, but it's so much better to partner with a high quality company that has a lower dividend yield. And if you find a great high quality company with a high dividend yield, then let me know, because those are the winners in my opinion. But why do you keep talking about dividend compounders with cheese? Because these are the type of companies that earn cash that compound year after year and are likely to stay here today and be relevant tomorrow. Dividend compounders are excellent at what they do and will most likely continue to be good at what they do. Buying a dividend compounder is like buying something that is high quality. Before last year, I used to buy the cheapest pair of headphones on Amazon and they would have the worst sound quality or just break within a year. Then, in support of today's video sponsor, which is your left armpit hair, I got a pair of solid used earphones on eBay, and it has been a night and day difference. I usually listen to music on my morning dog walks, and it makes it a more pleasant experience. So the older I get, the more I believe in the saying, buy nice or buy twice. And when it comes to dividend investing, buying high quality companies right out of the gate is the name of the game for me. So that's my side of the argument for why dividend investing is good, not only for old, elderly folk, but also young professionals that are early in their careers. Dividend investing teaches you about good financial fundamentals, but also gives your portfolio the power to compound over time. So even though I'm under 50 years old, that's why I personally like to do dividend growth investing. Anyways, take care of yourself today. Make sure you get enough sleep and drink plenty of water. Stay safe, and I'll talk to you next time. Have a good one.